Now that Allstate and State Farm have pulled out of the California insurance market for new homeowners, does this mean it's no longer possible to get traditional fire insurance in Sonoma County? Well, the short answer for many new homeowners is yes. So what are the implications for homeowners and how did we get here? So in this video, I'll explain what this means if you're looking to buy or sell your home. The problem is that fire seasons have been getting longer. Every year, the number of acres burned is increasing, and the biggest fires in history have all been in the last few years. For example, over the past few years, the cost of wildfires in California has risen from 40 billion to over 250 billion. And it's not just the effects of climate change which has impacted the insurance companies. You may be unaware, but similar to the secondary market for home mortgages, there exists a comparable market for insurance that provides liquidity to insurance companies. It's called the reinsurance market. So the problem for insurers is that the cost of obtaining this reinsurance in the secondary market has started increasing. And this increased cost is a direct result, it's not an intended result, but it's a direct result of the Fed's campaign to implement higher interest rates, which was put in place to fight inflation. Unlike the secondary market for loans, the secondary market for reinsurance it's facing a major liquidity problem because of these higher interest rates. And this is because investors who previously funded reinsurance risk now have competing, attractive alternatives in more sort of vanilla, less risky investments. So on top of the increase in claims, the increasing cost of reinsurance for insurance companies means it's harder for them to offset their risk. As a result of this, many insurance companies have been limiting their exposure and telling customers that they won't renew their policies, to the point where nearly 250,000 homeowners have now been told that they're not having their insurance renewed. This is a 42% year-on-year increase in the number of homeowners being left high and dry. So if you are a homeowner and can no longer get insurance, this is a major problem. The good news is that there is an alternative, which is a Fair Plan policy. The bad news is that it's more expensive. So what is Fair Plan, and is it any good? Well, Fair Plan is a state-run insurance scheme designed to ensure that all property owners, especially those in high-risk areas due to wildfire or hurricanes in places like Texas, have got access to insurance for their property when they just can't get traditional insurance. The problem for a company like State Farm, which has a 20% market share of the California market, is that if there is a major wildfire event and Fair Plan goes bankrupt, it's the insurers who are within the state who have to bail out Fair Plan based on their market share. So, State Farm, in pulling out of California, has basically said, well, we don't want to be on the hook for 20% of the cost of bailing out Fair Plan. So any homeowner or home buyer should be looking at their insurance options right now. If you used to use State Farm or use Allstate and have been dropped by them, you may be looking at smaller companies who are specialist insurers. The problem with these smaller companies is that while their coverage can be very similar and just as good as some of the other policies, but the fact that they're so small, they may not be able to afford to pay out if there is a major fire event. The best solution for many homeowners or home buyers looking to get insurance for the first time who can't get a traditional policy is going to get a Fair Plan policy to cover the cost of rebuilding the home in the event of fire, and then get what's called a wrapper policy from a traditional company to cover things like contents, liability, and other elements of insurance that you need. You can still get a great policy, it will just cost you that little bit more. The bottom line is, if you are a buyer, you need to make sure you've got an acceptable insurance policy, sometimes even before you make an offer, and certainly before you remove contingencies. Because of the recent challenges around getting insurance, the standard real estate contract forms have actually been changed to enable buyers to remove a physical contingency, but actually keep in place an insurance contingency. So if you are going to be making an offer, make sure you take advantage of this if you need it. If you are selling your home, even before you put it on the market, you need to get an indicative quote of what it would cost a new buyer to insure the home. Just because you have a policy that costs you, a couple of thousand a year doesn't mean a new buyer could get that same policy. If you don't get this indicative quote up front for a new buyer, you may find yourself being negotiated down from the offer price by the cost of the increased insurance. Well, this maybe doesn't sound so bad, but if they ask for 10x the difference to cover them for the next 10 years, then that becomes a major financial problem. The bottom line is, fire insurance is a major factor for both buyers and sellers. And like anything, you need to be proactive in getting ahead of the problems, regardless of whether you're looking to buy or sell. You will always be able to find insurance. It's just a question of how much it would cost and exactly what is covered. So if you want any information on insuring your home or how to harden your home in advance of selling it, give me a call on 707-238-2112 and I can put you in touch with some great people with multiple options for both insurance and hardening your home. I hope you enjoyed this video. Until the next video, go well.